Welcome, everybody, to our webinar. I'm Dave Hodge with NPF Investment Advisors. This is a fairly focused and detailed webinar about Section 351 exchanges. We are launching an exchange-traded fund, and so the 351 is part of that process. I'll be joined today by Chad Dutcher and Tyler Bosgraf. All three of us are partners and owners here at NPF Investment Advisors. Tyler is going to be the one that actually runs the product. So he's going to have a lot of the specific stuff around what the investments will look like. Chad does a lot of the administrative work and has helped put a lot of the detail behind it. And then I am registered as a securities representative. So things pertaining to the cost of the ETF and things related specifically to the offer are questions that I'll answer. I'm also the compliance officer here. So I make line calls as needed. The agenda that we're going to follow today is going to be fairly straightforward. There is a box at the bottom for Q&A. Depending on the device you're using, there's a series of like 5 buttons at the bottom. Of course, you all know too, when you came in, there was a little pop-up box that said, we are recording this. We will send the recording and the slides after today's call. So if you want to review any of the material, and of course, we're all available. If you're in Grand Rapids, come down and see us. Otherwise, give us a call, send us an email. We're available for follow-up questions after the presentation as well. But if you do have them, just go ahead and put them in the Q&A, and we'll be able to address those either in stream or after we finish the presentation. We're going to start with just a brief introduction of NPF, and then we're going to spend a little time talking about the conversion, the benefits, the diversification, and specifically what this exchange traded fund is going to look like. To start about NPF, it's Norris, Pernay and French. It's an old firm. We've been in Grand Rapids since 1933. The firm was founded by a guy named Abbott Norris. It was started as a family office for one of the local families that was here, and it's always been stocks and bonds. We actually have some very old records that are at the University of Michigan in their historical library that pertain to the origins of the firm. So we've been able to confirm that. It's always been locally owned. So we have 5 local partners, and it's Ford Pernay joined in the 50s, and then Charlie French joined in the 60s. All 3 are like deceased now and have moved on, but the firm has stayed partner owned in its whole existence, 92 years. One of the things that's happened over that time is now we manage quite a lot of money. It's about $2.5 billion of management for about 600 clients or so around the country, and even in different parts of the world. And over a long period of time, what'll happen is as some of you know, you'll have an account that's taxable, and maybe it's been an inheritance or it's been in a trust or something like that. Well, what happens is over time, the basis of the asset doesn't change, but the gains continue to compound over time. And so tax management becomes a growing issue over years, over decades, and that's what we're running into. And that's really what the impetus was. So why are we around for 92 years and now launching an ETF? That's why. It's for our clients. And we also do everything in-house here. So the planning, the investments, and the client services, it's all here. We're not using a call center in some other place. We're not using AI chatbots or anything like that. We're all real human beings right here in Grand Rapids who do the work. And we do it all ourselves. I would say that's another thing that we've really prided ourselves on over the years is we do have our own security selection team here. We've not outsourced that. We're not a manager of managers or any structure like that. We do eat our own cooking, so to speak. And that's been a legacy of the firm since the very beginning. Now, we're going to go into a little bit more detail on the 351 conversion. And I think, Chad, you up
That
for
would be
this?
me. So
All right.
thanks for the introduction, Dave, and appreciate doing the overview. So as Dave mentioned, tax management has become a kind of a big thing internally here, and we've been struggling with how do we marry kind of investment decisions and investment strategy with the tax planning specifically that we're doing with our clients. 5, 6 years ago, the SEC changed a rule where they allowed what are called actively managed ETFs, which simply means you can buy and sell any type of stock in the fund, and it does not have to track an index. And so shortly after that, the 351 conversion technique kind of started gaining a little bit more popularity as a way to facilitate a transfer of assets into an ETF in an in-kind way. So how does that happen? Section 351 allows for the transfer of appreciated assets into corporations without triggering capital gains. This is what enables the tax deferral. In a lot of ways, it's similar to a 1031 exchange in real estate, if you're familiar with that transaction. Ultimately, though, it was created in the 1950s, and people were using it to transfer assets like real estate, for example, into corporations, and that's what without triggering the capital gain. For this purpose, today, ETFs are actually treated as corporations under U.S. tax law. So think of the ETF itself, any ETF, think of it as just a business from a tax perspective, which allows the transfer of stocks, the property, into the ETF in kind in exchange for shares of the newly created ETF. That is at its core how the process or why it works. Tyler, next tab. So how does it work? Investors would transfer appreciated stocks or stocks that are down actually, but tends to be appreciated, or ETFs. So you cannot contribute mutual funds, but if you have an S&P 500 ETF or a NASDAQ 100 ETF, that can actually be participate in a 351 conversion. That would be transferred in, and you would receive the NPF Core Equity ETF into the or in exchange under certain diversification rules, which we'll talk about later. Taxes are then deferred until whenever the investor sells shares, which is unique with ETFs themselves. So separately managed accounts, actively managed mutual funds. If we sell a security, any security, and it's at a gain, that gain gets passed through to each of our tax returns. What's interesting with ETFs is if we sell a security or reposition out of a security, we are not technically selling it. It's passed to an authorized participant, they dispose of it, and we get a new security back. That transaction is what was what makes ETFs way more tax efficient than separately managed accounts or actively managed mutual funds. And gains are only then realized when the investor decides to sell the ETF itself. As I manage earlier, so the tax efficiency of ETFs allows us to be way more nimble when we're managing client assets. We're not so concerned. If Tyler at the end of the year says we need to sell Microsoft and buy Google, he can do that in December without blowing up our clients' tax plans or any client's tax plans for that matter. That unique tax wrapper of the ETF allows it so we can kind of really marry those two strategies. Next. So in a graphic, how does this occur? You have a portfolio of individual stocks or ETFs. They get transferred into the NPF Core Equity ETF in kind. It's important to note that this is a one-time opportunity. We'd love to be able to take additional assets after the fact. The tax law just unfortunately doesn't allow for that. The other unique thing is the cost basis and the holding periods actually can't carry over in kind, so one by one. So if you had a portfolio of 50 different stocks, some with very large unrealized gains, some with smaller unrealized gains, you would get tax lots back of the ETF with each unique holding period with unique dates and unrealized gains. So you could be very nimble. And if you had to rebalance or were donating shares for charitable purposes, you might, give your very low basis, lots for charitable, or your very high basis lots if you're just trying to realize a little bit of gains, but not too much, and rebalance a portfolio. So each of those unique things carry over in kind. So what are the primary benefits? As I mentioned before, it's the tax deferral. This allows, Section 350 allows investors to defer capital gains taxes, which enhances tax planning strategies for advisors. We get increased portfolio diversification. It allows us, the ETF structure allows us to reduce stock concentration, promoting diversification for a balanced portfolio. So, everybody kind of wants the next NVIDIA or the next Apple, right? And everybody would love to see it go from $10 to $100. Then it's always, what do we do next? And how do we tax efficiently draw that down or rebalance it or whatever? Doing that inside of an ETF makes that actually quite easy. And this also provides investor control over when gains are realized, which can be really helpful for retired clients, specifically younger clients who are trying to defer gains, older clients who are waiting for the step up, which we can talk about next. So who can benefit from a 351 conversion? There are a number of different scenarios and different types of clients where this can make sense. So I'll start with kind of the obvious one. The retiree who is, just getting into retirement, and has kind of some prime tax planning years. So when we're working, the old adage is, just defer your taxes as long as possible. And the idea is then to pay taxes at a lower rate when you're retired. Oftentimes those years are sometimes some point between when you retire, age 70, and then age 73, and required minimum distributions kick in. So the primary benefit here is we can continue to manage the client's portfolio regardless of an investment decision. We're able to manage the modified adjusted gross income for clients in a much more tactical and thoughtful way. Provides much tighter coordination in realizing other forms of income. So if we're doing Roth conversions or taking money out of inherited IRAs, those amounts of income would impact the capital gains costs, to the client. So by simply being able to make these transactions inside of the ETF, rebalancing inside of the ETF, we're able to be way more tax efficient for that pre-retiree client or that retiree client. So then later in retirement, so we're 20 years later in our 80s, and our portfolio has grown even more. And then, I think a lot of advisors have seen this. You get into that point in life, and you have some very unique positions that maybe have just been there forever, and it's extremely low basis. And you got this random Coca-Cola position that you paid $10 for, and it's worth much more, or a random bank or anything like that, or Apple. But at that point, many clients are just simply waiting for the step up in basis that occurs at passing. And so you can land on a stale portfolio for many, many years, just kind of waiting for the step up, because you don't want to pay the tax. The 351 conversion allows for a portfolio to be, kind of actively managed in some facet, to ensure that the portfolio doesn't get stale and it's actively managed and thoughtfully, until we pass away. High net worth families are another unique one. So, with a lot of planning strategies now that have come up with generation skipping trust, family limited partnerships, slats. A lot of these structures are subject to trust rates. And so the capital gains rates thresholds are at extremely low levels. You're paying the max rate extremely quickly. And so it becomes very difficult to manage capital gains inside of the trust, particularly when you don't need to realize those gains immediately. The 351 conversion, the ETF allows for gains to be deferred until the beneficiaries of those trusts choose to realize those gains, as opposed to when an investment decision is made by an advisor. So again, I always say my line to a lot of people is children charity, U.S. government. A lot of people generally like to maximize what goes to their families, what goes to their children, what goes to the charities, and then they just want to pay the bare minimum what they owe to the government. The 351 conversion, the ETF does a nice job of planning for that. Some less common scenarios. You can run into situations. So one of the tools that's kind of had a strategy that's gained a little bit of popularity over the past number of years, is something called direct indexing, where investors own the majority of individual securities that make up a broad index like the S&P 500. The purpose of this is to get a large level of granularity, to allow investors to tax loss harvest positions that are trading at a loss and replace it with a similar security. So an example that might be like, hey, like Visa's trade. I bought Visa 6 months ago. It's trading down. I'm going to sell that and replace it with MasterCard. The thing that occurs though, if the investor is no longer contributing assets to the portfolio, eventually you can find yourself in a situation called tax lock because there's no losses left to realize. The basis has been pushed down so much. And so you slowly but surely you kind of deviate from the strategy that you're intending to employ. The 351 conversion, we could accept all those securities, and you would have more of a broad, diversified portfolio. Lastly, just broadly, a portfolio of just significant unrealized gains and without opportunities for losses elsewhere. That's another situation that obviously makes a lot of sense. And then lastly, this is more kind of one-off, but younger investors, specifically ones that kind of have large positions in, say, QQQ, or they got into MicroStrategy at the right time, or NVIDIA, or whatever. And if they wanted to diversify some of that without realizing the gains today, they too would stand to benefit from a 351 conversion. So the SEC doesn't just say, "Hey," we actually had somebody reach out to us at one point and said, "Hey, I have $2 million in a Citibank," and I was like, "Can I just do the 351 conversion?" And unfortunately, you cannot. You need to have some other assets around it. There are diversification requirements. So what are they? So the first is no single security can exceed 25% of the total contributed assets. So basically, example, $1 million portfolio. I can only contribute up to $250,000 of any one stock, Apple, NVIDIA, whatever. And then on top of that, there's another requirement. The market value of the top 5 positions in the portfolio cannot exceed 50%. So you can't have 5 stocks making up 600 grand of that $1 million. So long as those two are met, we can move forward. Lastly, what's unique is you can contribute ETFs. We mentioned this earlier. So what does that mean? We look through to the underlying holdings in the ETF. So if you were to think about the S&P 500, it would say, okay, 6% NVIDIA, 5% Microsoft, 4%, Google or whatever. It's not looking at that S&P 500 ETF as one security. It's looking through to those each individual positions. So as it relates to the prior slide, if we contributed $200,000 of Apple, and then we had an S&P 500 ETF, we would likely meet, the compliance requirements there. So long as the underlying holdings in Apple and the ETF and the $200,000 position come to something under than 25% of the total. Taxes. So the primary purpose of a 351 conversion is for the tax benefits of the strategy. So as I mentioned earlier, it's just the deferral of capital gains and the preservation of tax attributes. So you can be extremely granular in terms of what you want to donate in terms of charitable and what gains you want to realize. ETFs themselves provide a lot of flexibility in investment decisions. We can obviously sell high basis shares, donate low basis shares. And then lastly, if you participate, we do have a third party tax attorney providing a tax opinion letter for all the participants within the 351 conversion, which basically just says, hey, we went through this whole process and we can confirm that it met the diversification requirements and other various requirements for the 351 conversion. Wrapping it up, so Section 351 allows for investors to transfer appreciated stocks or ETFs into the NPF Core Equity ETF and defer taxes under the diversification rules. Provides for tax efficient diversification, a lot of investor control and flexibility as it relates to tax planning, and long-term growth within the strategy, which Tyler will be talking about now.
Hey everyone, thanks for hanging with us here. And so now that we've covered kind of the background of NPF as well as, hey, what's the benefit of a 351? Why are we doing this? Why are we launching an ETF now? I think the question on everyone's mind is, hey, what's this ETF going to be? What's it consist of? And so there, really what we're taking our historical approach as a firm. Like Dave said, we've been around since the 1930s. We've been running SMAs on behalf of our clients since then. And we're just taking that existing strategy that's served us well over time and rolling it into an ETF for those tax benefits and that diversification. So really what it is we view it as a high conviction, kind of all cap portfolio of US equities. We view it as the core of a client's equity portfolio. This isn't a sleeve or a targeted allocation within it. This is designed to be suitable as kind of the entirety of someone's equity allocation. And then we focus on steady long-term growth. We don't find ourselves chasing the hottest thing. We try not to get blown up in the downturns. And it's designed to provide steady, profitable growth through time, and consistent returns as best we can. And then listed on the right there is just some information on the ETF itself. As for, hey, how do we approach kind of the investment management philosophy? The research process, like Dave was mentioning, everyone involved is here locally in Grand Rapids. We do this all in-house, and we've been doing it for those 90 plus years. So it starts with idea generation and screening. Hey, what companies and themes do we need to have exposure to within the portfolio? We conduct our own due diligence and research there. A lot of this is primary research. Hey, it's going through the 10Ks and 10Qs and company filings. And, we had a holding this morning, Abbott report, and going through the transcript there. And hey, what's management talking about? And then following up with questions. It's really your fundamental oriented equity strategy. Hey, where are companies going to be in 3 to 5 years from now? And how's that compare to how they're priced today? We take that to our investment committee, and then we have an ongoing review. On the strategy here for the NPF Core Equity ETF, I will be functioning as the portfolio manager there, with the investment team supporting me behind that. Again, diving into the investment strategy there, again, it's bottoms up research. We target 30 to 70 companies, with trusted management and a history of success there. Very often our holdings are things we've held or followed for 3, 5, 10, 15 years, and have a lot of familiarity there. Again, we seek strong returns on capital and free cash flow. And generally we have a requirement that any of our investments are profitable at the time we make them. We're not going after the speculative growth. Now, looking at, hey, how's it positioned today? Our sector exposure, we tend to be concentrated in technology, healthcare, industrials, and we tend to be lighter on banks, biotech, energy. Again, holding period, we look at 3 to 5 years through time for some of our growthier names, and 10 plus years for a lot of those steady eddies. Berkshire's one we've held for decades here as a firm. Turnover tends to be fairly low for an actively managed fund, typically between 20 and 40%. Again, that's where that tax hiccup or tax drag that Chad was talking about in the SMA strategy, that's where that comes in. And really this allows us to separate the investment management tax tail from the financial planning tax tail. And so that's why we decided to pursue this. And, we looked at it as, hey, there's a lot of benefit here for our clients. And if there's, other advisors or individuals out there that can benefit from this, we're happy to open it up to them as well. And then while it's bottoms up focus, there always is a bit of an overlay on, hey, what are some of the forward looking themes? Reindustrialization of the US has been a big one for years in the portfolio. In the past, it's been public cloud, and we rode that wave. That's why we have the tax problems we have today on Amazon and Google and Microsoft. And then the build out of domestic semiconductor manufacturing. We bought Applied Materials and KLA years and years ago, who sell equipment used to manufacture semiconductors. So as we build more fabs or semiconductor factories, they're beneficiaries of that. Summarizing it all, we view it as a carefully curated portfolio, aiming to capture durable, profitable market leaders that we know in and out, built with a goal to compound capital over the long term. Key dates and next steps in the process. So we're targeting, working from the end to now, we're targeting January 2026 as when the ETF will begin trading. January 18, what that means is anyone who's elected to participate, any securities participating in the conversion will transfer out to the custodian of the ETF, which is State Street. And then on the 20th, you'll receive back shares of the ETF with those kind of matching tax lots. Backing out from that, by December 5 of this year is kind of our final deadline of, hey, here's who's participating in this conversion process. Here's the assets participating. And the reason we need that time there is we need at least 45 days. And then you see in there that November 15th date as well. We'd love to have this wrapped up by then. We need that time so that we can run the diversification math and, hey, does this account qualify? Is there any changes we need to make sure are there, and really dot our I's and cross our T's on the compliance side. And so that's the timeline there. And then, how it works step by step. I know we've got a mix of existing NPF clients as well as some other advisors and individuals on the call here today. If you're an existing NPF client, you'll work closely with your existing advisor to walk through this process. For everyone else, feel free to reach out. We're happy to have those conversations. The next step would be submitting the portfolio for review. We'll work with you on, hey, does this qualify or not? Answer any questions. And then what's the timeline, the paperwork, and contribution process? And then again, that January 18 date is contribution of securities. And then January 20, it'll begin trading. And with that, we'll open it up to any questions.
I guess while you're thinking of questions, one couple that I'll throw out there. So we're all advisors, we're client facing. So we work with a number of people, and we've talked about this with a number of people we work with. And so I guess just to summarize it from a practitioner point of view, one of the things that we're really looking for as an ideal situation for this is high impact from a tax perspective and an investment perspective. That really constitutes an ideal situation for this type of exchange. So you may have a portfolio where there's a lot of embedded gains and it's very difficult to rebalance. And at the same time, the investor has a high tax rate. That really is the kind of the ideal setup for this, because you're getting that diversification literally for no tax consequence. And at the same time, the ongoing rebalancing is provided for and accounted for inside the ETF. And that kind of feeds in, like we were able to use our legacy of, we've always been kind of core equity. We've always had that focus in the US, and we've never been like a specialized technology manager or anything. We're just focused on our market. So the way that we manage stocks is dovetailed very nicely with that. And that creates kind of this opportunity. We're doing this for our clients, but it also is a really good thing for other advisors as well. So that's really a big point of what we're trying to explain here, is that like you're a practitioner or you're a private investor and you've got your own assets. Well, this is kind of how we think about it, is that. One thing I'll add is it's not explicit in any of the material here, is sometimes people will say, well, should I do this in my IRA or my Roth? And I would say the thing you could, but we're not pursuing that right now. And the reason is that with a 351, you're already tax sheltered inside the retirement account. So it wouldn't do you any good necessarily. You could just buy the ETF at a later date, because you're not going to pay any tax when you sell the appreciated stocks anyway. So that's one thing to kind of keep in mind, is we're really just talking about taxable accounts. The ETF is going to be publicly traded as well. So down the road, you can always buy it. It is going to be a public instrument. So you could buy it just like any other stock. And that's one other question that'll come up from time to time too, is, well, if I do this ETF, is this somehow going to be locked up, or do I have to hold it for a certain period of time? And the answer is no. If you can use the ETF in the same way that you use stocks, as mentioned before, you can donate them to charity. You can give them away to kids and other family members or whoever you want, or you can sell them or buy more of them. It's the same as any other publicly traded security in that respect.
And jumping in on that, I know Jason Zweig at the Wall Street Journal published an article a couple weeks ago. We got some questions on that from people we had been talking to about this. And so he talked about the benefits of a 351 conversion and the tax advantages of an ETF. But then I don't think it was clear in his article, if anyone on the call read it. He also talked about exchange funds, which are kind of the old way of doing this. So an exchange fund, the way that worked is multiple investors would get together. One might own a giant slug of Apple, another would have a giant slug of Nvidia, and they combine their portfolios all into one, going from a truly non-diversified mix to this diversified basket. One of the problems within an exchange fund is one of the IRS limits there is it's got a 7-year lockup. Once you go into it, you can't exit for 7 years. That does not apply on the 351 conversion into the ETF. So like Dave was saying, anyone who converted to it, on day one of it trading, you could sell the whole thing. Now then you would have significant capital gains, the same as if you had sold all the contributed assets.
We have another question. The first one. So are there any types of assets that are explicitly excluded from 351 conversions? Yes. The primary one would be that people are using these for would be mutual funds. There are some workarounds, particularly with Vanguard mutual funds. So currently, if you have a Vanguard mutual fund and a taxable account, many of those can actually be converted to an ETF at Vanguard and then contributed. But a Fidelity actively managed mutual fund, for example, could not be contributed. We can take, a fixed income ETF. I'm not sure if you wanted to use it to create diversification, that would work. But the big one that we cannot take would be mutual funds. Good question.
And Mohan, I can see you raised your hand. I'm not actually sure how to call on you in here. If you can type a question in there, we can certainly answer it then. In the meantime, any other questions?
Here we go. On highly appreciated stocks, I understand that a 351 conversion would avoid paying capital gains when you transfer it in. But then you say that each tax lot maintains its original basis and holding period, preserving attributes. Does that mean there would still be a large capital gain when selling the ETF, even if the ETF hasn't appreciated a large amount? Short answer is yes. So all you're doing is transferring the unrealized gain into another security to create greater diversification without the tax impact. So if the market were down, after this occurred, you could have a lower market value on the securities or on the ETF and still have an unrealized gain.
So on that topic, it doesn't eliminate taxes. What this does is it allows the shift of assets into an ETF where then on an ongoing basis, you don't have to pay the capital gains as, hey, we sell Microsoft and buy Google or vice versa. That's not generating flow through capital gains to you. If you sell shares of the ETF, there are still gains associated with that. Now you have a lot more flexibility of, hey, which tax lots do I want to sell to manage, my taxes there.
If 10 different positions are exchanged in the ETF, the result is 10 different tax lots. At least 10. It could be more because if the 10 positions had multiple purchase dates, each one of those would also transfer in kind. So if you had 10 stocks and each were purchased twice, you'd have 20 tax lots.
Yeah. So we've got another question here. What occurrences can cause an ETF to close, and what are the tax repercussions there? So this is actually a question, that we contemplated ahead of time, that we've gotten from some other individuals as well. The answer is, hey, what would cause an ETF to close? And that would be, hey, NPF decides we no longer want to operate this ETF and we want to close it. The downside of that is then everything within the ETF gets liquidated and capital gains are paid out to the holders of the ETF. Now we've thought through that, and the answer is, hey, what would happen? That would be a terrible experience for everyone involved. And so really what would happen, if you think about it, if NPF's entire investment team were to get wiped off the face of the earth, I'm gone, Dave's gone, our analysts are gone, our other portfolio managers are gone, our chief investment officer is gone. What would we do? is we take the existing assets within the ETF, convert it into, call it an S&P 500 or 1500 tracking fund, and that's how it would proceed on an ongoing basis. Because the worst thing you can do is have to liquidate all those securities, wrap up the ETF, and distribute it out. Hopefully that answers that question.
Mohan, I see your question or your comment. So you're correct in that it doesn't solve the concentration of one security. There's limits to that. The IRS unfortunately prohibits, one security from being contributed. However, if you were able to layer in a fixed income ETF or an S&P 500 ETF, a large position can then be diversified or be diversified down. But unfortunately, if it were just one security, it wouldn't meet the rules.
Yeah. On that note, if it is an individual security or two securities, that's where something like Jason Zweig was talking about on the exchange fund, that's where that can play a role. The downside there is it has to be a fairly significant amount of money for the operators of exchange funds to consider it. You're talking millions in a single name before it'd be possible to go that route.
Higher cost and a 7-year lockup period as well.
Yep.
Great questions.
Anything else? All right.
Well, if there's not anything more, we'll let everybody get back to their day.
All right.
Thank you so much for joining us today.
Thanks, everybody. Remember, we are going to send out a replay and the slides. And if you have any questions, you'll be able to follow up with us later. Thanks so much.
Bye now.